Welcome. In this video, I'm analyzing three companies: Indian Hotels, EIH and Mahindra Holidays. The current market price of Indian Hotels is 137, EIH 140 and Mahindra Holidays at 224. Using core ratios, I'm trying to understand which of these companies are worth investing and which companies we should discard of or not invest in. We'll look at the quarterly data first, the short-term picture as to what the company is doing in the quarterly analysis, that is year-on-year analysis. We'll look at the latest quarterly sales and compare that with the previous quarter sales, that is December 2019 with December 2018 quarter. Indian Hotels sales has grown by 3.72% from its previous year's quarter. EIH has fallen by 3.7% and Mahindra Holidays sales has fallen by 1.7%. The orange indicates the latest quarter. So both EIH and Mahindra Holidays sales have fallen. Let us look at the profit from its previous year's quarter. Indian Hotels profit has grown by 28%. In the previous quarter of the previous year it was 162. Now it is 203 crores. EIH has generated a 5.29% growth in its quarterly profit, and Mahindra Holidays profits have fallen from 31 crores to 5 crores in December 2019. That's an 83% fall in its net profit. Let us compare the sales of the 2019 with the sales in the recent 12 months. Indian Hotels sales last year was 4,500 crores and in the recent 12 months it has grown to 4,595 crores. So that's a 1.84% growth. EIH has seen a fall of 5.6% and Mahindra Holidays has seen in the recent 12 months a growth of around 7.2% in its sales. In terms of profit from 2019 to the recent 12 months, Indian Hotels has seen its profit grow by 28%. Mahindra Holidays has seen a 74% growth from 60 crores to 105, and EIH seen a fall in its profit to 129 crores from where it was in 2019. So that's a 27.3% fall. So EIH in the recent 12 months has seen a drop in its profits. In terms of net profit to cash flow comparison, we want to understand how much company has shown as net profit last year and how much cash actually has come in through operating activity. So we are interested in the cash inflows into the company. So the more the better, at least whatever company is shown as profit should come in as cash. Indian Hotels has received 257% more than what it showed as profit. So the profit was 276 crores and the cash coming in through operations was 711 crores. All of these companies' cash has come in against the profits being declared by the company. Mahindra Holidays profit in 2019 was 60 crores and the cash coming in was 263 crores. So that's a 4.4 times more or 440% more than the profit being declared. So we do want the cash to be more than the profit. So all these three companies have generated enough cash against the profit declared. The highest fall in terms of price from where it was 52 weeks back, the highest fall was seen in EIH of around 34% from its 52 weeks high price. Mahindra Holidays has seen a 12.3% drop in its price and Indian Hotels has seen a 16% drop. So all of these companies have seen a marginal drop except EIH at 34%. Next, let us compare the latest price earning with its average of 3 years and 5 years. We want the price earning to be below 25 times and most of these companies are trading about 25 times or latest price earning. Even their averages of the 3 and 5 years are quite high, and we can therefore compare or consider the current price earning with their averages. So Indian Hotels was trading at around 64 times its 5 and 3 years average, and currently it is at 45 times its earnings, very high. Even EIH is also at 45 times, although on an average basis it was trading somewhere around 50.7 times. And Mahindra Holidays is trading at around 38.1 times, higher than its 5 and 3 years average of 29.4 times. Next, let us look at the price to OCF. Like price to earning, price to OCF is a very important ratio to understand. Indian Hotels is trading at 22 times its cash earnings. Like earnings, we have cash earnings. When we calculated in the previous graph where we compared the profit with the cash flow from operations, here we are trying to understand where the price is per share, or what is the price per share and what is the cash earning per share. So we don't want to pay more than 25 times the cash earnings of the company. Indian Hotels has price to OCF of around 22 times, which is expensive, very near to 25 times. EIH is at around 27 times, again high compared to the benchmark, and Mahindra Holidays is trading lowest at 11.4 times, so this is good. Next, let us look at the price to book valuation ratio. This is calculated by comparing the market cap with its net worth. Market cap is the value in the market, whereas net worth is the value the company has given to its each share. So Indian Hotels in the market was trading at around 16,311 crores in all. The entire company's value in the market was around 16,000 crores, against which the company's actual value is at around 4,000 crores. So that's a 4 times multiple, a high multiple considering that my benchmark is 2.5 times. EIH is also trading at a high multiple of 2.7 times. Its net worth is 2,900 crores, and in the market it is available at 8,000 crores. Mahindra Holidays has the highest price to book multiple of 15.6 times. Its net worth is just 192 crores, and the company's value in the market is 2,900 crores, a very high multiple. I would generally avoid such companies where the net worth to market cap is more than 2.5 times. Next, we'll look at the PEG ratio, or the price earnings to profit growth ratio. We use PEG ratio to understand if the price earning that we are paying is that is justified by comparing the price earning with the profit growth. So if you are paying a certain multiple for the earnings of the company, we also want to look at how that earnings is growing. If the earnings is growing at a good high percentage, then that price earning is justified. So Indian Hotels, as we saw earlier, was trading at around 45.4 times its earnings, and that earnings indicated in blue, that is the last 5 years profit growth rate, was at around 32.5%. So that works out to a PEG of 1.4. So now when we look at the price to earning of 45 times, it seems it is justified because the profit is also growing, or that earnings for which we paid 45 times, that is also growing at 32%. So the PEG has fallen below my benchmark of 1.5. So I want to buy if the PEG is below 1.5. So I don't look only at price earning but also at the PEG ratio, and if the PEG is below 1.5, then it becomes reasonable. EIH is expensive at around 4.1. The company's price earning is 45 times, but its profit is growing at only 11% in the last 5 years. Similarly, we can look at the last 3 years data and then also compare how in the recent 3 years if the company's performance has improved. Mahindra Holidays has a negative PEG, which means although we are paying 38 times its earnings in the last 5 years, or from 5 years back, its earnings have been dropping, or that its profits have been falling at the rate of 6.29% compounded. So that's not a good sign, because if you're paying 38 times the earnings, we want to see that earnings growing instead of falling down. Similarly, we'll look at the PEG ratio of 3 years by comparing the latest price earning with the profit growth in the last 3 years. So Indian Hotels, again, we're paying 45 times, but its profits are also growing at 47%, which is a PEG of 1, which is a good multiple. EIH, the PEG has become worse at 7.7. Its profit has been growing at a slower pace in the recent 3 years at just 5.9% compared to the 45 price earning multiple that we will have to pay if you want to buy today. Mahindra Holidays in the recent 3 years also has seen a degrowth in its profit from where it was 3 years back at 11.4% compounded, whereas we are paying 38.1 times that earnings. So this is again a bad sign, because we don't want to buy a company when its profit has a degrowth from where it was 3 and 5 years back. Next, we'll look at the profit growth rate of 5 years and 3 years, which we have already noted earlier, but now in this graph we'll look together. Indian Hotels profits in the recent 5 years, indicated in red or orange, has been growing at 32%, and in the recent 3 years it has further increased to 47.3%. So the profit growth rate has increased faster. So this is how we should be looking at for our companies, that profit in the recent 3 years should be higher than what it was in the 5 years growth rate. EIH has seen a 11% growth rate in its 5 years profit, but in the recent 3 years the profit has slowed down to 5.9%. Mahindra Holidays profits in the last 5 years had seen a fall of 6.3%, but in the recent 3 years the profit has further fallen faster at 11.4% compounded. So this is a bad sign for Mahindra Holidays. Next, we'll look at the sales growth. Just we saw how the profits were growing for 5 and 3 years. We'll look at if there is a growth in sales over 5 and 3 years. Indian Hotels has seen a sales growth of 2.1% compounded CAGR growth rate over the last 5 years, and in the recent 3 years it is a 3.9%. So this is okay. I would want my companies to grow at least 10% in their revenue generation or sales generation. EIH has also seen a very similar growth rate in its sales as Indian Hotels. Mahindra Holidays has seen a very high growth rate in its sales of 27.1% in the last 5 years, or from where it was 5 years back. And even in 3 years, or the recent 3 years, although it has slowed down to 11%, it is still higher than the 10% benchmark that I have set for myself. So this has also done good. But when we look at the profit growth, although the sales are increasing, the profits are falling. There's a degrowth in the profit, or the profits are slowing down, although the sales are increasing. So this is a problematic sign that we should look at. Why, if the sales are increasing or growing at 11%, why is there a degrowth in its profits? Next, we'll look at the latest ROE, or return on equity. What is the profit generated on the equity or shareholders' money, and compare it with its 5 and 3 years average. Indian Hotels has generated 6.5% ROE in the latest year, whereas it has seen over a period of 5 years, it has seen a negative 1% of ROE. That is, it has seen losses in terms of last 5 years. In the recent 3 years, the average ROE is way too low at 2.7%. So the profits being generated on the shareholders' money is very low. Even for EIH, it is quite low at 6.1 compared to its averages of 5.1 and 5.7 for 5 and 3 years. So my benchmark as such is 15% and above. Mahindra Holidays is generating the highest ROE for the shareholders. 12% is the latest ROE compared to its averages of 17% for the last 5 years and 19.8% in the last 3 years. So compared to its averages, it has fallen down to 12%. So there's a sign of weakness here, and both the Indian Hotels and EIH is have not generated good enough returns for the shareholders. Now let us look at how the company has managed to generate returns on the capital employed. In this case, the returns is the EBIT, and the capital employed is the total debt and equity. So on the total capital employed, the profit generated is just 8.6% for Indian Hotels, EIH is generated 10.2%, and Mahindra Holidays has generated 10.4%. I would want my companies to generate ROCE of at least 15% and above. If you look for Mahindra Holidays, for both 5 years and 3 years, the return generated was around 17%. So this was a good sign, but in the recent or the latest year of 2019, the returns has fallen to 10.4%. EIH average ROCE has been below 10% for both 5 and 3 years average, and Indian Hotels averages were below 8%. So all these companies have a sign of weakness in them. Now let us compare the return on total assets. This is the profit or net profit that the company has generated on its total assets or the asset it owns, and compare that with its 5 years average ROA. Indian Hotels in the last 5 years on average has been making losses on its total assets at 0.3%, whereas in 2019 the return on assets was around 3.6%. So although it has turned positive, overall for the 5-year picture it's negative. So that's a bad sign. EIH has generated a 4.9% in the recent 2019 year, and the average was around 4.2. So this is good. This has increased. There's no benchmark as such for ROA. Whatever the average of the peer group companies are, we can take that. Mahindra Holidays has seen a fall in its ROA from its average of around 3.4% of 5 years, whereas in 2019 it generated just 1.2%. So all these companies are facing pressure in the recent years. Let us look at the asset turnover, that is how much was the sales against the assets employed by the company, or what was the multiple between sales and assets. So we want the companies to generate more sales against the asset it owns. Indian Hotels has generated less than what assets it has in terms of revenue. So its assets are more than the revenue being generated every year. In 2019 it generated just 0.7 times its assets, that is the sales were just 0.7 times its assets, and EIH generated half the sales of what assets it owned. Mahindra Holidays managed to generate 2 times more than the assets that it was holding. So Mahindra Holidays has done better. Let us look at the inventory turnover last year and compare that with its average turnover of the last 3 years. Here what we are trying to look at is what is the inventory holding the company has in its balance sheet, and what is the sales it is doing. So we are again looking at sales to inventory multiple. So we want it to be as high as possible. Indian Hotels inventory is the lowest, and its sales is 54 times higher than its inventory, and its averages of the last 3 years was around 50 times. So it has done higher sales against its inventory holding. Now most of the time this is service oriented companies or industry, therefore inventory holding as such will not make much of a difference, or it will not guide us in a proper way. EIH inventory turnover was around 33 times in the recent year, and Mahindra Holidays has seen a fall from its average of 6 times to 4 times in 2019. Next, let us look at the profit after tax of the last 5 years in total, and what is the cash being generated in the last 5 years through operating activity. In the earlier graph we had seen for 1 year, that is 2019, how much profit the company had earned, and how much cash was being generated. So here too we want the cash being generated to be as high as possible. Indian Hotels has seen a total loss in last 5 years aggregating to 154 crores. This is the loss Indian Hotels has generated in the last 5 years. Against that, the cash being generated is 2,852 crores. So although the cash is coming in, the company is showing losses of 154 crores. So this needs to be investigated as to what is the reason for this difference between profit and the cash that the company is earning through operations. If you would want, you can let me know in the comment section for Indian Hotels what is the reason for this difference. EIH has seen a 195% higher cash being generated than the profit being declared over the last 5 years. So its profit for 5 years was 697 crores, against which its cash earnings was 1,359 crores. So this is a good sign. Similarly, Mahindra Holidays too has generated 2.9 times more or 294% more than its profits. Now we'll look at the cash flow from operations and how much of that is still free cash left with the company to be invested in the financing activity, that is paying dividend, doing buyback, bonus, etc., or paying off loan. So we are looking at the 5-year cash coming in through operating activity and how much was invested in those 5 years in buying assets and what is the free cash flow. So Indian Hotels had generated around 2,800 crores in terms of cash. Out of that, 1,629 is free. So the company has invested around 43% in buying assets of this cash that the company had. So I don't want the company to utilize more than 50% of its cash earned through operating activity in buying assets. And if it is investing more than 50%, then we should be able to also see growth in terms of net profit margin and profitability growth. So the free cash the company was holding in the last 5 years was 1,600 crores. So this is a good ratio. Although the company's profits, although the company overall in the last 5 years has shown losses, its cash earning is good. EIH has utilized 69% in buying assets and it has 426 crores left over as free cash. Mahindra Holidays has 54% utilized in buying assets of the total cash it had earned through operating of 1,500 crores and 710 crores is left over as free cash. So in terms of CFO to free cash flow comparison, all the three companies have done well. Now we'll look at the average PAT of the last 5 years. What is the average profit every year the company has been making and what is the current 12 months profit. So we are comparing the recent 12 months profit with its average profit that these companies have earned in the last 5 years. So on an average, Indian Hotels was making a loss of 31 crores every year, and in 2019, or rather in the recent 12 months, the company has made a profit of 354 crores. So that's a change or turnaround in its profits in the recent 12 months. EIH has seen a 7% fall over its average of 139 crores. So this is what it was earning in the last 5 years, and in the recent 12 months the profit is around 129 crores, so very nearby to its average. Mahindra Holidays has seen a mild increase near over its average of 104 crores of profit after tax. Next, we'll look at debt to equity. What is the debt and what is the equity ratio, or how much was contributed, or what is the borrowings against the total equity contribution. And therefore, if the debt to equity is high, the interest coverage, which compares whether the company would be easily able to pay off its financing cost or financing liability. So Indian Hotels has a debt to equity of 0.4 times, meaning its debt is only 0.4 or 40% of the equity contribution. So this is good. I want the debt to equity to be below 1 times. But its coverage, that is its EBIT, is just 2.5 times its interest payment. So if it's paying an interest of 1 rupee, then its EBIT or earnings before interest and tax is 2.5 times or 2 rupee 50 paise. So this is a low multiple. I would want to see debt to equity to be below 1 times and the coverage to be above 4 times. That is, the EBIT has to be at least 4 times more than what the company is paying as interest cost. EIH has a low debt of 0.2, or debt is just 20% of equity, and its coverage is also high at 5.5 times. So this is a good ratio to look at. Mahindra Holidays. Mahindra Holidays debt to equity is very bad at 8.3 times. Its net worth is very low compared to the equity contribution by the shareholders, and therefore its coverage is very low at 2.9 times. That is, its EBIT is just 2.9 times more than its finance cost. So I would not invest in a company where the debt portion is very high, and this is way above the 1 times benchmark that I have set for myself. Next, let us look at the net worth. What is the actual value of the company as per its books, and compare that if it has any contingent liability or any hidden liabilities which is not shown in the balance sheet. So we don't want to invest in a company whose contingent liability is exceeding 20% of its net worth or 30% of its net worth. Indian Hotels contingent liability was just 12% of its total net worth. So the company's value as per its records or as per its book was 4,000 crores, and its contingent liability was just 474 crores. So that's at 12%. EIH contingent liability was lowest at 4%, but Mahindra Holidays contingent liability is very high at 1,000 crores compared to its net worth of just 192 crores. So I would not invest in a company like Mahindra Holidays where its contingent liabilities are more than its net worth. Next, we'll look at the promoter holding and pledge shares. Promoters holding should be above 40 to 50%. That's a standard benchmark, so that we are in a safe company. At least we know that the promoters are also having a higher stake in their own companies. Indian Hotels promoters were holding around 40% approximately, EIH at around 35%, and Mahindra Holidays promoters were holding 67%. So Mahindra Holidays promoters are holding the highest, and we don't want the promoter pledge of shares to exceed 20% of its holdings. None of these companies have pledged their shares, so this is a good sign. Next, let us look at the debtors to sales. This is the ratio which we need to look at to understand how much payment is still to be collected from customers against the sales of the latest year, that is 2019 sales, and what is the total debtors shown in the balance sheet. So we don't want the debtors or payment to be collected to exceed 30% of the current year sales. Indian Hotels have to collect just 7% of 2019 sales from its customers. EIH had to collect just 10.8%, so these are all good. Mahindra Holidays has seen it has to collect 50% from its customers of the 2019 sales, so this is extremely high. I would not invest in a company whose debtors to sales exceeds 30%. In terms of debtor days, that is how fast it is collecting whatever it has to collect from its customers, I don't want it to exceed 90 days. Again, Mahindra Holidays has exceeded that, and it is taking 181 days to collect payment from its customers. So this is a very bad scenario for Mahindra Holidays. Not only has it to collect a huge payment from its customers, but it is taking 181 days or giving credit of 181 days to its customers. EIH is collecting within 50 days, so this is reasonable, and Indian Hotels is collecting within 26 days. So this shows management efficiency in terms of collecting payment efficiently from its customers. Net profit margin of 2019, Indian Hotels was earning around 6.4 on its total sales. EIH NPM was around 7.3 and Mahindra Holidays was lowest at 2.7%. And finally, we'll look at the dividend yield percentage, that is, at the current price, what kind of dividend you can expect from the shares. Indian Hotels was giving around 0.4 and EIH around 0.6. Mahindra Holidays didn't give any dividend in 2019, or at least on the current price, there is no dividend yield as of 2019. So this concludes my analysis of these three companies, and we'll give it a ranking in terms of scoring, and try to understand which of these three companies is good. For me, Indian Hotels has been making losses over a period of 5 years on average, which is an out for me. And EIH also, I'm not sure. We'll have to look at the scoring first. And Mahindra Holidays is out because its contingent liability is very high, its debt to equity is very high, its debtors to sales ratio is very high, its debtor days are very high. So all of these things indicates that I should not invest in Mahindra Holidays. So I've given score to all of these three companies. What I find is that if we look at the net score, Indian Hotels has got the highest at 71 points, and EIH and Mahindra are close by at 63 and 64. But none of the companies I find worthy of investment because of multiple reasons. You can see for EIH, the price earning was 44 times, very high, and the PEG of both 5 and 3 years are also very high at 4 and 7. So EIH is also not worth investing. Indian Hotels last 5 years, as I mentioned earlier, has a loss on an average basis. And Mahindra Holidays, a lot of its numbers are not good in terms of debt to equity, debtor days, and so on. Even price to book is very high at 15 times. So I generally would avoid all the three companies analyzed in this particular video. Thank you for watching this video.